investor. I'm your host, Ian Robertson, and today I'm joined by Chris Larsen. Chris is the founder and principal of Next Level Income. He began his journey at 21, acquiring his first single-family rental while pursuing degrees in biomedical engineering and finance at Virginia Tech. With more than 20 years of experience now, he's navigated diverse real estate ventures from development and private lending to syndicating over $1.5 billion in commercial properties since 2016. Chris, welcome.
Ian, great to see you again. How are you doing?
I'm good. I appreciate you taking some time out to talk with us here.
Always.
I want to start out by just
Yeah.
pointing out something kind of strange, but also fascinating to me. Previous guest on the show, Angela Dotson, she also went to college in Virginia, also was in the med tech space, the medical device space for
How
many
about that?
years. And you guys
Yeah.
have gone completely different directions. She doubled down
Yeah.
on med tech. You're now switched out to real estate.
Yeah.
I guess before we go into real estate,
Yeah.
how do you see the medical device space? Like, what was your mindset for the many, many years that you
Yeah.
were in there?
Yeah, that's a great question, and it's interesting because a lot of people say, "Oh, when did you switch from med device to real estate?" But you said it. I bought my first property at 21.
That's right.
I wasn't in the medical device field until my late 20s, so I think 25, 27, somewhere in there. So I always saw myself as an investor, Ian. And my issue was I bought a few properties and I ran out of money, so I had to figure out a way to make more money so that I could continue to invest. And my rule was always invest 50% of what I made after taxes. So I bought that first property at 21. I bought another the next year. I forget if it was the year after that or 2 years after that. I bought my third property, and then fourth and fifth and so on. But I needed to make some money. And I learned about the medical device space because I was working for somebody that had a friend that was doing it. And because of my medical or biomechanical education, when I learned about it, I was like, oh, this is what we study in class. This is really cool. And when I learned that you get to go into surgeries and work with doctors and hospitals, I was like, this is a really interesting field, and it can be very, very lucrative if you do well in it as well. And the other good thing is, real estate can be cyclical. We've seen that, for those of us that have been around a while. I saw my parents lose their jobs in the savings and loan crisis in the early 90s, way back when. So I've seen the cyclical nature of real estate, and the medical world is typically pretty stable because people go to the doctor, they go to the hospital, they have surgeries, they take medications. So that tends to be a nice stable counterbalance to the investing world in real estate.
That's interesting. Just wanted to touch on that. So
Yeah.
it's very nice. So you said it again. You started with real estate before even using what you got in your degree. You clearly knew going into it that this was a plan, your game plan. Now, who put that into your ear? Who mentored you? Where did you get this idea? Like most college kids are just like, I'm here for the ride. I'm doing whatever I'm doing. I don't know what I'm doing.
Yeah, and I think there's a few layers to that, and that's a really intriguing question when I kind of dig back. And by the way, if you're listening today, you want to get a free copy of our book, go to nextlevelincome.com. I know the camera's a little weird here with the focusing, but nextlevelincome.com, and we'll send you a free book. I talk all about my story. But Ian, I lost my father when I was 5 years old, and Malcolm Gladwell talks about this in I think it's David versus Goliath, I think is the book. It may be Outliers, but if I recall correctly, I think it's David versus Goliath. And I think when you lose a parent, you realize, or even a friend or somebody at a young age, you realize that life is finite. So you just tend to look at life a little bit differently. I always felt like I had something kind of like pulling me, through life that motivated me. I also lost my best friend during my freshman year of college, actually right in between. So it was I was very acutely aware that life was finite, and I wanted to live life on my own terms. And after my friend died, I went back to school the next year, and I said, okay, like I want to live life on my own terms. What do I do? And I said, okay, you need money. So I started day trading in the stock market. I was actually doing pretty good. I was making like $5,000 a month. This is back in the late 90s as a junior in college. But I wasn't sleeping a lot. It was very stressful. And I said, man, I'm 20 years old. Like, I can't do this for 20 years. Like, I'm going to kill myself. just with the stress and everything that's happening. So I started learning all that I could. You mentioned that I got a degree in finance. I got an MBA in finance as well. But over the course of those 5 years, I read over 250 books on money, business, the stock market, real estate. And I realized that real estate was a good strategy for me and my personality. It's kind of like a get rich slow path. And what it did was it said, okay, if I can do this plan, it's, from a, statistical perspective, it's going to give me a pretty good chance of achieving a specific outcome. And my goal was to increase my passive income above my living expenses. So I knew, like, if I followed this plan, I could do it on a pretty good timeline, a pretty reasonable timeline, within a curve. So that's how I came up with that. I had a lot of different people that kind of mentored and shared stuff with me along the way. I had our family friend Clint that introduced me to the stock market initially. People around Blacksburg. I had Sherman Ragland up in the Baltimore, DC area that took me into downtown Baltimore, looking at just a gut job building down there, and just got to tag along and learn from people and go to different meetings and stuff like that. But I started in residential and then ultimately converted over to commercial about 10, 12 years ago at this point. And that allowed us to really scale from then on.
So of what you learned in school and clearly out of school with 250 books, my goodness. What would you say your formal education impacted you up until this point versus what you sought out yourself or through other people?
Yeah. And look, this is good advice for those young people out there listening. Like, I love the saying that, what you get out of school, what you get out of college is what you do outside of class. So it's those connections, it's the networking, it's the relationships, it's the bike races that I went to and what I learned training for those races. It's, the books I read and all those sorts of things. Formal education has value. I think it's diminishing. It's been diminishing over time because we have the internet. And I'll never forget, I was having a discussion in a hospital lounge about a decade ago with a young man. And he said, I think everybody should be entitled to a free education. I said, you have a phone in your pocket? He goes, yeah. I said, take it out. I go, everybody has access to a free education. Maybe that's what he said, access to a free education. And I said, but everybody does. And I said, pull your phone out. And he held it up and I said, it's right there in your hand. It's amazing. My son can go onto ChatGPT and ChatGPT can write an article or an essay that's so good on, the democratic nature of the country. And then we have another AI tool out there that's so good that you can feed that essay into it and it will edit it so that it's undetectable that it was written by AI. I mean, that's incredible, right? It's incredible what we have out there right now. We have so many tools and information, at our fingertips that we can just look up. So I think there's still value in formal education. I think that the big thing for me that stands out, Ian, aside from, kind of some of the things I touched on, is as an engineer, you're taught to make assumptions, then you're taught to solve a problem, then you're taught to iterate, to go back, challenge your assumptions. And I think whether you're investing or you're just looking at things in the world today, like even the political world, people don't like to challenge their assumptions. But if your assumptions are wrong, you are probably going to come to the wrong conclusion. So it taught me, my education taught me to be comfortable with challenging my own assumptions because you had to do it to be successful as an engineer. So that was the big thing that really stood out to me.
Yeah, absolutely. And so education is changing. For better or for worse. Where it lands is to be seen, but
you're making it better right now.
That's right. I mean, you're absolutely spot on with access. We all have access to free education. And it's how people use it and how formal education will adjust over the years to come, how the job market will change based on this new technology and with AI, like you're talking about. The one thing that's not going to change is we all need somewhere to live, right? So, so you started with single family. Curious, did single family, did you start with like I'm dorming this out to a bunch of college kids that you knew, or how did that start?
Great question. Yeah. So, and great guess. Maybe you read my book and you were setting me up with that. But yeah, it's called a house hack now, right? You buy a house and you rent out some rooms. So I was in Blacksburg, Virginia, college town. I bought a 3-bedroom townhouse and I rented 2 of the bedrooms out to my friends. And then I ended up getting to know my neighbor next door, and I knew he was going to be leaving. And when he graduated a year after I graduated, so I stayed for grad school, I said, "Hey, if you ever want to sell the house, let me know." And so he got a price, and I think I was actually a real estate agent at that point. I think I got licensed. So he gave me a price, and I said, "Hey, I'll pay this, and I'll handle the transaction. You won't have any fees." So he ended up making more money selling it to me. It was very simple for him. And then I ended up with 6 units now, right? I had 2 3-bedroom townhouses um, next door to each other. So I went from a 3-bedroom apartment building effectively to a 6-bedroom apartment building, and did that. And that's how I got started there. And I think that's a great, it's great to be creative. If you're trying to do your first deal and you're out there, be creative. Buy a house where you can put like an Airbnb in the basement or convert that. I was talking to one of my coaching clients, and he's looking at a house with an RV garage. Have you seen these? They're big out west. It's
I
wild.
haven't. No, I always just
Yeah.
see the RVs just sticking outside,
Yeah.
hanging out.
Yeah. This thing's 1,000 square feet.
Wow.
And I was like, dude, build like a loft in there, like a man cave, You can have a loft with furniture. He's got a classic car in there and a couple 4-wheelers. I'm like, you could fit all that in there and have like a kitchen and stuff in the back. You could actually have an apartment in there, which would be really cool. So there's a lot of really cool things that you can do and get creative and almost any environment, high price, high interest rate. There's still things that work out there. You just have to understand the different strategies that are out there. And, some people, we've got Airbnbs now, Ian, on our property. People tell me, they're like, why would you want somebody like on your property? Like, why would you do that? I'm like, why would you want to pay your own mortgage? It's like, it's just, you have to choose. What do they say? Choose your difficult, right? So it's like, you get creative and you can make real estate work a lot of different ways.
Yeah, I love that. And so
Yeah.
most of our listeners are
Yeah.
looking at the space of alternative investments for the first
Yeah.
time, trying to get into it in some capacity, seeing if it's a right
Yeah.
fit or where it's a right fit. And so I want to play around with a few different paths with you. I know you've done a lot.
Yeah.
And so
Sure.
I want to see, just from your perspective, where you started and where you are
Yeah.
now, and how other people, or where along your path people should be starting or can start.
Yeah.
So I guess, if you want to just break down first your very first deal, how did you afford a house?
Yeah. Yeah, great question. If I may, I'm going to just back up just a little bit from there. And I want to kind of talk about 3 things. We talk about, like with our coaching group, we say, make, keep, and grow. So the first thing, if you want to invest, is go find a way to make a lot of money. And then the second thing, I'm going to try to be brief here. The second thing is find the appropriate tax strategy and legal structures to protect your money. So if I could save you $1 on taxes, that's going right to your bottom line, right? It's a great way to do it. So make as much money as you can, keep as much of that as you can, and then have both active and passive strategies. So if you're doing your first deal, as you were just kind of saying, Ian, be prepared to be active. You're going to make more money doing that. Some cool things to look at, you can still do house hacks and make those work. Look at different geographies. So I talk about, I did a recent podcast on geographic arbitrage. So you can type that into my little Chris GPT, my little search bot in the bottom right-hand corner of our website at nextlevelincome.com. If you type in geographic arbitrage, you should get some information on that. But move to an area of the country that's maybe you can make about the same money, but it's more affordable to live. And then you could buy a house, right? And then you could, do a house hack, or like I was saying, do an Airbnb. We're big and we have 20 mobile home parks as well. And mobile home parks are still very affordable. So like the average rent in our mobile home parks last year was up about 17.5%, significantly more than apartments or homes are. So you can kind of look at these different areas that are going to move during different times of the real estate cycle and get creative with those. If you don't want to be active, then go learn about how to invest in passive syndications. That's one thing we work with our coaching clients on. Learn as much as you can, find syndicators, find operators, find sponsors that you can trust, and you understand the strategy that you can do. One of the things that I know you probably have a lot of self-directed IRA investors that do private lending. I think it's a great time right now to do lending because you can lend and get double-digit returns, whereas equity investments, you're looking, the returns have kind of come down over time as interest rates have gone up. So kind of be the bank. And that's one thing we do with our debt fund. We actually have a lot of investors with self-directed IRAs that do that. We operate, we lend and do that for our investors, but lending is a great way to do that right now. When the cycle is a little bit earlier, like 10 years ago, I would be talking about building, say, like spec homes or new development, because you could build at a lower cost per square foot, or you could do value add deals where it doesn't cost as much to improve the property, but you can increase the value very rapidly. So again, just to kind of recap here, if you're looking to get started, be willing to learn, be flexible, be willing to be creative too, so maybe do some of these things that other people might not want to do. And look at all the options that are out there, including potentially moving to an area of the country that's more conducive to how you can, make more money doing these things.
Yeah, absolutely. Do you think that we're in a spot right now where development, like new builds and all of that, is going to increase, at least the returns on that to increase rapidly?
So I think we're in a challenging spot right now for if we're talking about, say, like multifamily, for instance, so residential real estate. So over the last few years, so if we go back kind of to rehash some things, so COVID hit, interest rates were rock bottom. People started moving, people were forming households. People wanted a place to live. Rents were going up double digits. So everybody wanted to invest in apartments. Builders wanted to build. And if you could get money at like almost 0% interest rates, so like 2, 3, 4%, it's like, and building costs were still pretty reasonable then a lot of people started to build in these areas where rents were going up. Say Nashville, for instance, Austin, Texas. The problem is all that supply has been coming onto the market the last 1 to 2 years, and it's going to continue to come onto the market this year. And then it's going to drop off. So I think we're going to see the opportunity for development kind of to start over again. I think the challenge we have now, Ian, is prices are high for homes, for apartments, and rates are high. So right now it's been, we have an affordability gap that is at or near historic levels between the cost to own a home and to rent. So I think, if I'm a consumer out there, if I'm a renter, it makes more sense for me to rent right now than to buy a house and do that. I can get a better deal and do that. So, that's where you have to say, okay, well, what do I do? Do I build now? Do I, buy a value add deal? Do I lend? Do I find, a deal that's distressed and maybe lend to that? These are some things that can potentially work right now. But I think some of this has to kind of shake out a little bit. But if you can get into one of these areas and you can provide an affordable option, I think that's going to be an area that's going to outperform over the next 10 years.
Okay, fair enough. Yeah, definitely looking out in the long term as well with your investment. Too, because right now everything is shaky, and the stock market itself, like there's a lot of volatility. We don't know what's happening, and so getting into your first deal now seems like a strange time to do it, but it's never a bad time to start, right? You have to start.
Yeah. Well, that's a great, you bring up a great point. Like, there's no like normal time, there's different parts of the cycle and that. But I think when we're in these times that are, like you said, strange, there can be distress too. So you might end up being able to pick up a good deal from somebody that needs to sell, needs to refinance, doesn't have a good option. You can potentially come in as a partner and do something like that. It's hard to borrow money right now. in a lot of ways. So if you can be a cash buyer, have a cash partner that can come in and do that, or like I was saying, be the bank, go out there and lend. You can get pretty good spreads on your money right now for stuff like that. So there's a lot of different ways you can kind of look at the landscape and find deals that will work in today's market.
Definitely. So I want to look at one thing just on two sides of it with private lending, because that is a huge conversation right now for obvious reasons. When you're lending to people, are you primarily lending to flippers, or like what are you primarily lending to, or who?
Yeah, great question. So we have a couple options. So we have our debt fund, and our debt fund is lending only to investors that are fixing and flipping single family homes. And we have a relationship with the vast majority of these investors, like 80-90% of these are investors that we have repeat borrowers. So we're lending to them, and we're typically lending to them for 6 to 9 months. So somewhere in that time frame. Our average duration right now is about 200 days. So, they're buying homes, say, starter homes. So I mentioned that affordable. I really like this segment. If you can buy a house for a couple $100,000, put 25 grand into it and sell it for 300 grand, that's a good profit, right? So, if this person's paying, say, 14%, they can still make a really good return if they're able to flip that house in 6 or 9 months and do that. So I think that's a great area. The other area is going in and providing money to those operators that may need some cash to get them through this period in the apartment market. We have rents that have been flat, sometimes depressed in some markets. Supply is coming on board, but we have supply rapidly dropping off, and rents are starting to rebound, and cap rates are starting to rebound as well. So, we have a fund where you can get in and you can take advantage of that in a preferred position. So that's totally different. That's in the commercial space. So I think it's important to differentiate between those two. But you can get really nice risk-adjusted returns. And our debt fund, for instance, is liquid. Like, you can put your money in and you can request to get it back out. There's not a long-term lockup like 3, 5, 7 years, as you're going to see in some of these longer-term equity positions.
Yeah, that is pretty uncommon from what I've seen, at least. The liquidity piece of it, because that's half of it. There's the investments that you're making long term, and it's long term. You don't care what happens in 3 years, as long as in 10 years it's better off. And then there's the investments where you want to make shorter term returns and be able to pull if you need to, maybe some sort of emergency fund beyond that, or something to that effect.
And if I may, it's really important to understand where you are as an investor. I've talked to investors over the years, and they're like, I want the highest return, and I don't care when I get my money back. And a year later, they say, hey, I want my money back. And you're like, well, we still own this property. It's like, well, I need it for whatever. It's like, well, we have this other option that's liquid, you said no to, but they're like, well, that didn't pay enough. It's like, well, you kind of have to, I talk about dial. You have, and I say dial just because the letters, make a word, but depreciation, income, appreciation, liquidity, you're typically going to get about 2 of those, so if you want liquidity and income, great. If you want liquidity, appreciation, depreciation, you have to give up one of those typically. Like, you're going to have to give up something when it comes in that. You can't have your cake and eat it too. And if something sounds too good to be true, someone's like, hey, we're going to give you 20% returns. You're not going to pay any taxes. You can get your money back whenever you want. Then you have to start thinking, like, it sounds a lot like Bernie Madoff, actually,
right.
When it comes to stuff like that. So if it sounds too good to be true, you have to start asking, like, how did this person or group figure that out when no one else really has that out there? So be realistic with what you need, and be realistic with what the options are out there.
Yeah, definitely. And even, certain investments, they may have those higher returns, but they're for very, very small amounts. So it's, on a larger scale, it's probably unrealistic.
That's a great point. Yeah, you can make some really great returns in smaller deals and smaller amounts, but can you scale that? You could lend on a mobile home and make 18%, but how many mobile homes are you going to lend on? You could, Warren Buffett does a lot of them. It's good business.
No, exactly.
Yeah.
So, so where would you say, if you're talking to somebody and they make enough money, they are putting money away each month
Yep.
that they're just putting into the stock market. They're told just throw it into the
Yep.
S&P 500 and let it do its thing.
Yeah.
When is there a point where it's okay, now you have this amount of money, let's pivot, let's consider real estate? Or is it, let's get creative first, let's think about different
Yep.
ways we can do this, and just hit the ground running with nothing? Like,
Yeah.
where's that point where you
Yep.
would normally recommend somebody jump into real estate?
Yeah, that's an excellent question. And again, I'm not a financial advisor. I'm not if you're listening, not your accountant. I'm not your attorney. But if you look at the way that the ultra rich invest, so we're talking about individuals, families with 9 figures or more. You look at how they invest. They don't invest like the typical investor, which is we 80 in the stock market, 20 in bonds. They do way less than that in the stock market, typically like 20 to 30%. And then they're putting 20 to 30% in things like real estate. And then they're putting 20 to 30% in things like fixed income. And then they're putting like 20 to 30% into, businesses, alternatives, those sorts of things. So what I would do is, again, going back to the make, keep, and grow strategy, get to the point where you're accredited, make 200 grand or more a year. Then you can start looking at those options. That doesn't mean you can't start investing in real estate on your own, but model your portfolio after where you want to go. Do you want to be ultra wealthy? Do you want to operate like that? I would suggest that you should probably be putting 25, 30% of your money in real estate if you wanted to follow that type of model. We're big believers in cash value life insurance, which is essentially fixed income. You get guaranteed income, but we have a specific strategy we use so we can have the benefits of that, but we can also invest from those proceeds. Once you're doing all those things, maybe you don't need to work anymore, or maybe you're working and you want to generate more income. Starting a business is another great thing to do. Just because you start your own small business, that doesn't mean that can't be part of your portfolio. So, I just kind of outlined a few different ways that even if you're just getting started or early on in your investing career, can operate and model your own portfolio after the ultra rich. And I think, what you guys do at Madison Trust is awesome because, I've had a lot of investors, we've sent several to you guys, which say, hey, I got $5 million in the stock market. I'm just learning about these alternatives, but I have a bunch of money locked away in qualified plans. I want to take a big tax hit, but I want to take advantage of some of these alternatives out there. And they're able to do just that with some of the tools that we have out there now.
Right, exactly. And yeah, there's that big gap in what everybody is being told, the norm, so to speak, and what's actually happening with the ultra high net worth individuals and family offices and all that. Like I've been hearing studies where it's about 50% of their portfolio is alternative investments spread, like you said, between real estate and private debt funds, private credit, situations, the fixed income. That whole half of their portfolio, the rest of the world, the rest of the country is just ignoring, and they're thinking it's all in one spot. And it's just recognizing that gap and saying, okay, I need to do something, whatever it is. That's huge. And so you mentioned starting a business. I think that's fair. I think when you're starting with real estate and it is more active, I think to a large degree that is your business,
absolutely.
right? Especially
Airbnbs. Absolutely.
Do you want to talk about Airbnbs? Like, because you do have several there. Like, is it too much work? Like, where's the line? Like, do you outsource the management of it? Do you do it yourself? What do you think about that?
Yeah, so we have a small portfolio. We only have 2 Airbnbs on our property here in Asheville, and we looked at scaling it, but you hit the nail on the head, and it's a very active business. And if you look at the management fees in short-term rentals, you're looking at like 20 to 30%, sometimes 40% in these. So you could say, "Oh, I manage them myself and collect that." There you go. You're starting a business, right? You're managing them yourself. So manpower is a challenge, cleaning's a challenge. So we have cleaners that we have in place. There's a lot of AI, there's a lot of technology out there that you can utilize to help alleviate some of this stuff, pricing tools, those sorts of things. But it's not as easy as just buying a property and putting it on Airbnb and boom, you're going to make a lot of money. it is a business. You do have to understand the markets that you're going into. You have to understand the laws and regulations around that market. They're very restrictive here in Asheville, for instance. So, you can do like a midterm rental, like a month or more with a detached property, but you can't short-term rent it. It has to be part of your house. There's all these things you have to be conscious of. So yeah, if you're going into something like that, just be aware that short-term rentals definitely much more of a business than kind of real estate. It's real estate and a hospitality business blended together. So you should get your real estate returns and you should get your returns from your hospitality business. Or if you're looking at it, you should be able to pay somebody to do it and still make good money. But it's really tough right now to pay a bunch for a property, finance it at 7%, pay all those fees and turn a good profit. It's pretty challenging.
Right, exactly. And I even see that, and I guess you can speak to the markets that you're in, but I see that a lot too with even long-term rentals. The fees aren't the same, but the margins are so small that the fees dig into it. And if somebody
Absolutely.
doesn't pay, if you've got that one person isn't renting for a month,
Mm-hmm.
you've got the
Yeah.
void. Now you've just lost all the gains you made
Yeah.
for the past year.
Absolutely. Yeah.
So
Yeah, it's a tough time right now for like residential real estate in general, just to buy a house and make money on it. It's very challenging.
yeah, so that's where I look at the passive opportunities
Yeah.
right now, especially making being a
Yeah.
strong consideration for people.
Yeah.
I've been looking a lot at the private lending side of it. There is
Yeah.
also these syndications. Do you think? I guess you're sort of biased, but I'm going to ask it anyway. Like,
I am,
uh,
yeah.
what, like, if should somebody be choosing between private debt and uh, commercial real estate? Should they
Yeah.
be should they be considering both? Is it
Yeah.
private debt for now with the idea that we're going to pivot in a couple years when it makes sense? Like,
Yeah.
where are we at?
Yeah. Yeah. So yeah, we're all biased to some degree, right? So I think you say, okay, look, I've been investing in real estate for 25 years. You said 20, but I'm over 25 now. So you keep adding those years on. But again, where we are in the cycle, equity investments are becoming more challenging to get a risk premium. When rates were low, lending rates were low, you're seeing like 4 or 5, 6% getting paid out on some like debt funds and those sorts of things. Now like our debt fund pays 6 to 10% depending on the investment level and the time that you have invested. So like if you're getting 10% in something that's liquid and you're getting monthly income, you can get your money back. And somebody says, hey, here you can get 12% and lock your money up, for 5 years. That's tough, right? Like that's a tight margin right there. But you can do both. So I talked to an investor yesterday. He just sold the property. He's got a bunch of cash. He wants to redeploy it into long-term equity investments. But I said, well, you could put it in something like a debt fund, and then you could draw from that debt fund as those opportunities come up over the next 1, 2, 3, 4, 5 years and do that. So learn about all the options that are out there. Consider what your tolerance is as an investor and what you need. If you're coming up on retirement, you value income and liquidity, it's going to be different than maybe somebody like you or I, Ian, that are earlier on in our lives and we're really valuing long-term appreciation, tax benefits, and those sorts of things. And then build your portfolio in accordance with that.
Yeah, I really appreciate what you said there about just the creative component, using the private debt investment as your sort of like your money market account, how people would traditionally look at
There
it.
you go. Yeah.
But it's money market rates versus what you're getting in this fund, and
Yeah.
it's a big
Yeah.
difference. But again, it's all taking just a little bit of time to get
Yeah.
creative and think about what's your strategy, what makes the most sense
Yeah.
for you, how do you get
Yeah.
started, and how do you continue after you started.
Well, and here's another thing. So, you have to look at different pieces. So let's say, and look, my wife has a self-directed IRA, so I understand how they work. So let's say the minimum investment in a deal is $50,000 or $100,000. So I'm putting my money in our self-directed IRA. We're waiting to get to that $50,000 level. Well, what do you do in the meantime? Like our debt fund can take 25,000, and you can put put smaller increments on top of that. So, you can use one as a tool to get to the other and do that. And, maybe you have money in a self-directed IRA. I can't use my self-directed IRA money for our deals, so I have to look at other stuff. We can't self-deal and do that. So look at what you have in your portfolio and where it is. Look at the options that are out there, and consider your own situation, because mine is not necessarily going to be like yours or somebody else that's listening here today. And then figure out what makes sense for you. But that's why all these options are out there, because they might be a good fit for different people at different times.
Yeah, absolutely. It's true. We can't all be doing the same thing at the same time, or somebody's gonna, be on the wrong side of it. And it may swing too far.
Probably.
Yeah, I mean, that's what happens with housing crises, a lot of the times. But I want to I appreciate your time. I want to respect your time.
Absolutely.
And do you have any final thoughts? How people can find out more about you and your business and all your opportunities.
Yeah, Ian. Well, first off, thanks for what you're doing here. We love to participate and do as many educational things as we can do. And in that, again, you can get a free copy of our book at the website, nextlevelincome.com. We also have coaching platform, a community, which you can check out on the website as well, or you can send an email to coaching@nextlevelincome.com. And then if you want to learn more about our investment opportunities that are out there, click on the invest link. So we got a ton of free education. We got a great coaching community, and we have investments that are out there. So wherever you are on your investing journey, hopefully we can help you out there at nextlevelincome.com.
Perfect. I appreciate it, Chris. Thanks.
Ian, it's been a pleasure. Great to see you again.